Does it feel like your dollar is purchasing less and less by the day? And is the steady erosion of your purchasing power putting your retirement at risk? How can investments in safe haven assets like gold and silver stop the bleeding? Gold is expected to benefit from several drivers in 2024. In this video series, we will cover the top 5 gold price drivers and reasons to invest in gold in 2024. To learn about all 5 reasons right now, plus a bonus, see the link to the full article in the video description. With prices still elevated, high interest rates, and the mounting national debt, the present and future purchasing power and cost of living of everyday Americans is more and more uncertain. If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator. Gold price driver number 1, the beginnings of a global financial crisis in 2024. Building on our previous videos, the number 1 driver of the gold price for 2024 can best be summarized as the cumulative effects of the previous drivers and leading to a possible global financial crisis. In the past 2 years, the cracks in the global economy have started to show in various sectors. The UK pension crisis, the no-bid Bank of Japan market, and the bank failures of Silicon Valley Bank, Signature Bank, and others are a handful of examples. Though having the appearance of isolated incidents, these various crises present as symptoms of a larger and deeper illness, which is an overly levered, indebted system. Central banks around the world can only paper over these problems for so long. Eventually, the government and institutional band-aids can no longer hold back the blood flow of what is really a systematic, gaping wound. Arguably, this may be one of the reasons why central banks around the world are increasing their collective holdings of hard assets, such as gold, onto their balance sheets, as opposed to US dollar reserves. One word: preparation. Gold is a Tier 1 asset that has no counterparty risk, is no one's liability, and has only increased in value during a time that can best be described as a 40-year-plus debt cycle. Not coincidentally, this period aligns with the rise of widespread non-asset-backed fiat currencies that accelerated in growth after the abandonment of the gold standard in 1971 by the United States. During this cycle, the ability to increase the global debt without the need to increase the gold supply made way for an extremely leveraged system. The aforementioned recent banking and bond market crises serve as mere coughs and sniffles to the underlying disease of debt and leverage that is surfacing despite the mass amounts of fiscal medication that central banks are injecting into the sick patient, that is, the economy. At some point, the disease becomes too strong to mask. Gold has served as a universal safe haven asset and store of value for thousands of years. The US dollar, the cleanest shirt in the fiat laundry basket, will likely serve as an initial safe haven due to perception formed by many years of conditioning. Eventually, the strongest fiat lifeboat, the dollar, will reveal its numerous holes. One can surmise from viewing these recent economic trends that we are seeing the beginnings of an end of a failing 50-year faith-based fiat experiment. It is worth noting this period is the exception, not the rule of humans' history of commerce, although many living do not know any different. With the further revelation of these economic fault lines, we may be seeing a reversion back to the historical mean of the necessity for sound money backed by actual, tangible hard assets, not faith and trust. 2024 gold price driver bonus. Buy low. Take advantage of headwinds. Ironically, anyone who's interested in buying gold should quietly hope for a stronger dollar in the near term, and that the Federal Reserve's pivot from hiking to cutting to be delayed. Why? Buy low. This has the effect of keeping gold's price down, or given the recent activity, keeps this asset temporarily range-bound. It is worth noting that in the year 2023, practically every possible headwind to gold existed. High interest rates, a stronger dollar, savings yields finally returning, increase in bond investments, and a momentum-fueled equity market. Still, in spite of all these counter forces that typically push down the price of gold, the yellow metal made all-time highs in 2023 and has remained above its new support level. This should tell you something about this asset. It has remained extremely resilient in times where it should be going down in price. Another short-term driver that creates a great buying opportunity for gold is the initial onset of a recession, coinciding with a steep equity market correction or crash. At the end of 2022, the prospect of a recession in 2023 seemed imminent, but didn't surface, at least within the government data. Opinions may vary on this subject depending on one's lived experience of 2023, of course. Many macroeconomists have pointed to the lag effects of the Federal Reserve's tightening policy being delayed so significantly due to the immense amount of fiscal stimulus that has been injected into the U.S. economy within the last 3 years. This stimulus has essentially delayed the felt pain of the aggressive rate hikes. Again, many economists differ on this subject. If a recession is to finally take place in 2024, accompanied by a large equity market crash, gold is the first commodity to suffer, but the first to recover. Why is this? As seen in prior market crashes, panic selling ensues among traders. To cover margin losses within the market's steep downward correction, a general liquidation of anything of value follows. Hence, the mass selling of gold creates liquidity. This drives down the price of gold temporarily. This is the opportunity. Then, typically, the flight to a safe haven asset, such as the US dollar, takes place. Nearly simultaneously with this crash, the Federal Reserve begins cutting interest rates at a rapid pace and as a result, creating inflation, thereby negating real interest rates. As a result, this in turn gives rise to a flight to another safe haven and defensive asset, which is gold. At this stage, gold has already decoupled from the S&P and quickly recovers with the price shooting up as the equity market further corrects downwards. Also, the dollar's strength continues to weaken as a result of the accelerated monetary easing from the U.S. Central Bank. This pattern has been observed to various degrees in past market crashes and recessions. More recently, the Great Financial Crisis of 2008 and the tech market crash of the late 90s and early 2000s. A new gold bull market emerges as a result. If past is prologue, this is one more price driver dynamic to pay attention to. Whether you are in the soft landing or hard landing camp in terms of economic forecasting in 2024, the best present option for gold investing is to dollar cost average into gold while still at its present low and range bound. Therefore, the classic investing advice still stands. Buy low. With this in mind, 2 quotes from the famous Canadian hockey player Wayne Gretzky come to mind. I skate to where the puck is going to be, not to where it has been. Also, you miss 100% of the shots you don't take. If you are interested in learning more about gold and its role as a portfolio diversifier, hedge against inflation, protection from counterparty risk, and building generational wealth, see the links in the video description. If you are a serious investor with at least $100K in investment savings looking to take advantage of the most competitive gold prices, see the link in the video description to attend a free gold educational web conference held by Augusta Precious Metals. Thank you for watching. Please like and subscribe if you enjoyed this content.